Mona, we do have to start off with the election and the positioning in financial markets heading into this election, and now the repositioning, at least for some folks, that we've seen over the last couple of days here. Any sense here as to whether the price action that we've seen on Wednesday, Thursday, and today is going to be reflective of what we should expect over the next few weeks?
Yeah, it's a great call out. And look, you highlighted one key factor, which is the elimination of the uncertainty. That was first and foremost for the markets that were a little bit timid going into Election Day. Over the last couple of days, we have seen a definitive election outcome. We have probably seen a definitive Senate outcome, and we're heading towards that House result as well. So the good news is some of that uncertainty and some of that volatility, as you noted, has subsided pretty nicely over the last couple of days for investors. Now, what we're watching going forward is, one, what is this broadening of market leadership that we did see begin in the third quarter? What does that look like going forward? And in fact, a lot of the pro-growth policies that the Republicans have put forth, if some or all of them go through, we think that means the continuation of that broadening of market leadership. So we've already seen areas like small caps and mid caps play some catch up over the last couple of days. Sector-wise, we've seen some of those more cyclical areas, including industrials, financials, energy, all starting to play some rebound, seeing some rebound as well. We do think that that broadening of market leadership theme does have legs. Independent of what was happening in politics, we were seeing lower Fed funds rate, lower interest rates, as well as a broadening of earnings expansion driving that story. We think the addition of those pro-growth policies adds some fuel to that fire. Now, on the other hand, we also saw this trend of Treasury yields rising. Part of that was because economic growth was expanding, but part of it was because potential inflationary policies may be in play.
I am curious, absolutely, and I am curious, just to stay on the small cap side of this, particularly with the Russell finally within kind of spitting distance of a record high. It's a place that it hasn't been in for quite some time, and we've seen over the course of this year a lot of folks really looking for a broadening of that the market trade. It would sort of happen, and then it would kind of pull back for a couple weeks later. If this does indeed have legs, and we are going to hear from some of these smaller companies over the next couple of weeks as they start to report earnings, I am curious as to whether you think there's going to be enough confidence out there for the outlooks, and not just how they performed in the most recent quarter, but do you think that some of these executives will have enough clarity and confidence to guide higher for 2025?
Yeah, it's a good call out, especially on small caps, because look, that is a very highly leveraged part of the economy as well. They are very dependent on labor costs. Labor costs make up a big percentage of their cost structure. From our perspective, our kind of overweights in the cap space are in the large cap and mid cap space. We still, to your point, want to see a little bit more proof point on the small caps as they get through this economic cycle. Keep in mind, there's also a lot more of those quote unquote zombie companies or negative earners in that small cap space. So we do think if you're playing the broadening of market leadership, the mid cap and even the large cap space, both on kind of that growth value cyclical parts of the market, still make a lot of sense here. What we'd say more broadly is the earnings growth picture will drive, to your point, probably what the performance will look like in the year ahead. And the good news is we are looking at broader S&P 500 earnings. This year, slightly below 10%, but next year we could see double-digit earnings growth driven by those pro-growth policies, but also by a Fed that's moving rates lower and inflation that could be in line as well.
I liked what you said earlier, Mona, about how the price action prior to the election was kind of timid, which suggests that now people have a lot more conviction in buying up equities in particular. And I know that you recently upgraded the financial sector, Edward Jones, and you remain overweight in the industrial sector because of that cyclical factor. Are companies themselves likely to revise up their outlooks? We already heard from these banks and these industrial companies for the third quarter earnings season, and they didn't have that much visibility. Now that they do have that visibility, do you expect to see meaningful upgrades from them?
It is interesting. We all know kind of enacting real policy change takes time. The Tax Cuts and Jobs Act, for example, doesn't expire until the end of 2025. So in the near term, the new administration doesn't kind of transition until January 20th. So over the next few weeks and certainly over the next few quarters, we could still be seeing materially the same policy environment in place. So really what will be driving the economy and earnings during that period will continue to be how does the consumer hold up and how does the labor market hold up. And thus far, we have seen a resilient consumer driven by a labor market, still probably still holding up there at 4.1% unemployment, but certainly we've seen better supply and demand. Job openings have moved lower, et cetera. So this is still an economy, in our view, that has moderated from a very kind of outsized move in the post-pandemic period. Certainly not headed towards a downturn or recession, but a slowdown is likely. And I think that's probably what we're going to get over the next 2 to 3 quarters. And until we get that policy clarity and what's going to happen in place, that will probably be a 2026 story, if anything.
Got it. As we talk about a broadening of the equity rally, of course, there are a lot of other assets that are also getting caught up in the euphoria after the election, including Bitcoin, surpassing $77,000. We know there's a ton of money parked in money market funds right now. Is some of that money moving off the sidelines, and is it going into Bitcoin, or is some of the money going to Bitcoin being taken away from equities, perhaps not being allocated to equities and going somewhere else?
Yeah, certainly we continue to see an outsized amount of cash and cash-like instruments on the sidelines. I think the number is something like $6 trillion plus for money market funds. CDs, we know, are still there. Rates, as we've talked about, have remained relatively elevated, even at 4.3% 10-year Treasury yield, looking a lot better than really what we've seen in any time in recent history. Now, our recommendation, of course, is if you are sitting in a pile of outsized cash, meaning cash beyond what you should be owning for your kind of next 6 months or so, this is a great opportunity, we think, still to kind of think about redeploying that into either allocations in equities and bonds. But if you're looking at the bond space in particular, investment grade bonds, adding a little bit of duration here, we think makes a lot of sense. We still think the crypto space remains speculative. So we think, generally speaking, think about the allocation strategically.